The markets went sideways, but we were still able to make between $5,000 and $8,000 this week, depending on how you managed your systematic trades. Now, one of the beauties of trading systematic trades is that no matter what the market is doing, whether it's bullish or bearish or just consolidating, you are able to make money day in and day out. And as you start to take the different trades, you are able then to create different combinations that work well for your personal account size. Now, for those who are newer to the Trade Speakeasy, it does take time to learn the different trades that we have on. But the beauty of it is that you have years worth of data inside the Discord that demonstrate the strength and consistency of the systematic trades. So we were really blessed this last week to really have a great trading week. The different range of systematics continued to hit all of our scalps. And for those that don't have the capacity to manage your trades throughout the day, you could have put in easy stop losses in order to take your profits before the close of the day. Now, usually we go through the different trades, but I feel like we've done that a lot recently. So instead, I thought we might talk about a couple of allowed us to do well in these markets. So one of the big things is that a lot of trades that we set up for people and that we talk about are trades that as you go through different market environments, you want to learn how to trade them slightly differently. So a trade that we had been taking was this double diagonal structure. A double diagonal structure is a very interesting structure where you are both long and short both sides of the market. So here you can see in the strategy that you have this put side position and you have this call side position, and it creates these kind of two mountain tops. You let it bake in the background, and then as the time goes on during the week and time comes out of your structure, you are able to make a really nice return. Now, on this particular trade, I'll show you below, is that here you are paying a debit to get in, but your max loss is actually lower than the amount that you paid, is because your entire range from here to here is profitable no matter what the price of the S&P is doing. So if you have a system in place like we do where we trade gamma, we really like to analyze where those gamma positions are clustered and then set up these diagonal positions. And really, all we are concerned about during the week is just that price stays within our range. And as long as price is doing that, then we don't really have anything to manage. The other thing is you can see that our chance of profit is about almost 90%. Now, this does fluctuate as time goes on because things like the VIX and volatility will shift, and this chance of profitability won't stay stagnant throughout the entire duration of the trade. But usually you'll see your chance of profitability actually increase as time comes out of the trade because you will see a broadening of the profit range. So when you very first enter this trade, it does look a little bit wonky, right? So this is another trade that we recently put on. You can see the net debit is about $2,000, but the max loss is actually only $400. So that's really what you want to concentrate on more than what you're paying to get in. What you're paying to get in is to be able to have those positions in place. But the thing you need to concentrate on is what your potential max loss is. And really the max loss is only $400 because as you can see, no matter how far up the S&P goes, you're going to make some money. And really you only have downside risk. And so in this particular setup, so all we had to know is that the S&P was above 75.50 before March 6th. So as long as that's happening, then we should be fine. The other thing is this trade setup actually takes advantage of volatility. So right now you can see that the volatility is around 13%. And we know that because this weekend we already have action in Iran and we already have volatility likely to spike up, this position will actually increase in its value as the volatility goes up. So this was a really nice position that we would systematically put on week over week or every 2 weeks, depending on the type of account you have. But it was also a nice hedging position because we were able to make more money as the VIX increased in the event that there are events between the US and Iran, which we're now seeing take place. So, learning how to do these diversity of trades and knowing what you're kind of expecting to happen in the market really does allow you to take advantage of all types of trades. So something that we can go into option strat is that we can build this double diagonal. And so essentially what you'll see is probably one of the key things is you have on the top side your long positions. So this would be a long put and this would be your long call. And on the bottom, you have a short call and a short put. And so essentially what you are creating for those who like to trade things like credit spreads, you have essentially here what looks like two different credit spreads. So it looks very similar to an iron condor if that's something that you trade. But the diversity of the trade is that, as you can see here, the cost of entry is actually a net credit. So you're actually being paid to put on this position, but your max loss is very high because you have a very wide spread on the top and the bottom. So it is a very wide potential max loss. Now, a trade like this might be interesting to somebody if they had a really strong conviction that in an overnight move, the price of the S&P was likely not to do very much. So by having those short legs, the ones on the bottom, by having those closer to the current price, you're actually mitigating the cost of the longs significantly while allowing that to benefit from the time decay. And really what you're focused on in this trade is that you have a very high conviction or high expectation that the S&P is going to stay within a very specific trading range. Now, if that's not your expectation, if your expectation is that throughout the week or 2 weeks, that the S&P really could have some wild swings, and then maybe at the end of the week come back towards close to that central area, then having what we call a debit diagonal spread, is actually a more appropriate trade. And the reason is, and I'll just like narrow the range here a little bit and give us some time on the expirations. So essentially here, what I'm saying, what I am expressing in my trade is a couple of different things. So first of all, like I said, this trade, when you put it in as a high debited position and not a credited position, your expectation is that during the week, you are going to get big swings in the S&P, but that there is a potential that towards the end of the week, the S&P can come back to wherever it was on that previous Friday close. So if you want to visualize it on a chart, your expectation is that the week could give you really long wicks on the top and the bottom, but the body of the trade is going to be quite narrow. So based on that, you're actually putting your long position in really close. So some people might know this as a long strangle. A lot of people like to play these on earnings when they're expecting that price is going to give them a really big push, like a gap up or a gap down, and then hold after the earnings call. And so there are some stocks that kind of historically do that. And so you might not have a strong conviction if something will gap up or gap down, but you do have strong conviction that it's going to gap and hold. So you might put on both sides of the trade where you have on at the same time both a long call and a long put. However, such a position is extremely vulnerable if you have a drop in volatility or what some people call IV crush. Because basically you are paying, especially if you have like an earnings situation or there's some kind of news event that people are waiting to come out, you are paying a lot for volatility. And when that metric drops very quickly, then a lot of the value just gets sucked out of your contracts. And so then even if you were right on the trade, you're not going to make a lot of money. And even here, I can demonstrate that. So down here, it's showing us implied volatility. And if I just drop this back, you can see that the amount of my max potential profit shrinks significantly. So, I mean, I'm not expecting volatility to the VIX to drop to 5 over the next 3 or 4 days. So I'm not concerned that that's going to happen right now. And not that I would be concerned about that anyways, because 5 or 8 handle on the VIX is exceedingly low. We just don't see that low of a number. But that was just to kind of give you a demonstration of what happens with high debited positions when the VIX drops against you. So this is something that you have to be very cognizant of when you're thinking about how you want to do a double diagonal. But again, the other thing that you want to consider is, what is your thesis over a duration of time? Because one of the main things about this trade is that you do have those short positions on here. You do have the short put and the short call. They are further out the money than the long positions. So they're not impacting the position that much. The core positions you have is really that long call and that long put that are up on the top. But you do have some time on this trade if you were to set this up. And we do have a similar trade to this on that we put on Thursday. But the first thing you have to consider is that you do have a lot of time on this trade. You do have, for us, it was 7 days till expiration. Here you would have had 5 days until expiration if you were to open this on a Monday. So you do have this kind of initial profit loss graph where essentially you're making money if the price moves up, but you're not making that much money if the price moves down. However, if the price of the S&P were to drop, you would also know that likely the VIX is going up. So if the VIX increases, as you can see here, your profit range to the downside actually starts to increase. So even if the price were to drop against you, because the VIX is likely going up into that downside move, you are actually expanding that profit range. And so that just gives you a little bit more hedging to the downside. Then the other thing is that the more time that can get taken out of your position, you can see that your kind of profit area starts to increase. That hump starts to get a bit higher, which if you can see this chart on the side, this is showing you your profitability. So your profit potential increases significantly the longer you can wait in this trade. So as long as, day over day, as you're looking at the charts, you're seeing that, okay, we are just grinding within a very reasonable range of where we're making profits, then you can just let this trade kind of sit on and bake in the background. And if you look at so I've moved the glider at the bottom, so that the slider at the bottom, so you can see what the profit loss would look like if we waited all the way until Friday to exit this trade. So something you can see quite quickly is that really we have very little loss potential on the upside. So this is probably a position where if I were to put it on, I might not be very stressed out. If this position were to run all the way up, I probably wouldn't manage this trade because my max potential loss is just $200. Not that you should be lazy about managing your trades, but if you do have 30, 40 positions on at the same time, you may want to know which ones are the most urgent to manage and when, just so that you're not getting like mentally exhausted. But the thing that I do have to worry about is on the bottom side, if the VIX doesn't go up, because if the VIX were to go up, you can see that my range of profitability does start to increase on the downside. So really but if the VIX were just to stay flat, let's say the only thing I really have to be concerned about is if the S&P really starts to test below the 67.25. Now, of course, if I am more worried about the downside position, something I can do is actually widen out my debit spread. So as you can see here, right now, my max loss on the downside is about $1,100. But if I widen out that debit spread, then my max loss becomes $360. It does become a little bit more expensive to enter this trade because of the fact that I'm giving more power to that long put position. But you can see that my max loss has technically been cut in half. And my max profit hasn't actually changed significantly. So again, as long as the S&P is above the 66.75 and below the 70.25, I'm really doing just fine. And I am starting to benefit both, well, I'm benefiting from the time decay as the price of the S&P starts to move between this area. Now, something that the graph is showing us here, if you notice in the background, this like blue area, this is a standard deviation curve. And I don't know if you can see, there's like these very faint black lines right here. And this is the one standard deviation above and below. So essentially, it's telling us that as long as the S&P is within a one standard deviation move to the downside or to the upside, I'm probably going to be making some money. So you can see my chance of profits here is 73%. So, usually when we're putting on this type of trade, we like to see something closer to the 80%, but that's something that we can work around. And this is something where you might start playing with your different strikes to see if you can increase your chance of profit and decrease maybe your max loss by either expanding or reducing the size of that spread. So this is a trade, like I said, for probably throughout 2025, we liked to trade this type of trade, but we would trade it more as a double calendar. So that is where the long and the short strike share the same strike, but they have different expirations. And the reason that we would like these is that first of all, they're easier to manage. And usually it's because you can get a smaller max loss on the top side and the bottom side. But something that is very difficult for this trade is that if you do have a volatility crush, you start to get this kind of central pit. So if the S&P doesn't move enough to the upside and hold, or move enough to the downside and hold, and the VIX is dropping against you, then you have the potential for a loss in the middle section. So this is one of the things that you really have to be careful of when it is that the market dynamics are changing. And something that we have all been experiencing, even if we just look at the S&P, is that the S&P has just really been moving sideways. This is a weekly chart, and you can see we've had just weeks of inside bars. And even on the monthly chart, we have an inside month. And so it's showing you just how tight the consolidation has been, because really since the end of October, we have really not gone anywhere with the market. And even the doji candles we see are really, really short, even from tail to tail, or from wick to wick. So these, you want to keep all of this in these details in your mind, because there are different ways to kind of skew this type of trade in order to make more money and to hedge your risk. So this is a trade that we've adapted by turning it into that double diagonal, double debit diagonal, which I can show you here, where it looks like these two kind of mountain humps. And that has been working for us really nicely the last weeks. And maybe I can show you. So here you can see that towards the end of Friday, we were already up around that $820 mark. And we were able to close that out for nearly $1,000. So it was much more than a 50% return, since this did cost us debit-wise about $1,700. So it did kind of give us about a 70% return. The other thing is that the max loss on the trade was less than $1,000. So depending on how you calculate your return, if you calculate your return on risk, we actually got 100% return on risk. If you calculated your return on investment based on the debit that you entered to get in, then the return on your invested capital was about 70%. For being in a trade for only 7 days and getting a 70% return, and it being really low risk and almost no management, This was no management. We haven't managed any of these trades. It's just deciding when you want to exit. But the nice thing is for people who have a really busy schedule and 3 or 4 zero DTE trades throughout the day, they can be doing something like this and just have it in the background and allow that portion of their portfolio to be able to be working for them. Because one of the things that often people forget is, a lot of people will do day trade, like learn how to do day trading, and then have really long duration swing trades or a lot of stock. And then they don't have any kind of diversification in any of the times in between. So they don't have a lot of trades that are kind of productive in a week or productive in 2 weeks or a month. So either they need to be in a particular trade for like a year or 2 years or 3 years, like you would with stocks, or they need to make fast decisions. It's fast trading, scalping, zero DT type trading where you have a lot less time to really like manage the trade and manage the risk. This kind of gives you kind of a mid-duration trade that allows you to stay in the trade for the week and still be able to make money without putting too much capital at risk. But just because we are interested in different duration options trades doesn't mean that we are not also in shares. And so for people who are in the Discord, oftentimes when an entire sector is like getting ready to kind of blow up or is really in this kind of it could make a really long duration move because it's had such a long basing, then you might want to just get that share exposure, especially if the shares aren't too ridiculously expensive, right? It's not like I'm asking you to buy ASML, which is like over $1,000 now per share. But something we did talk a lot about, and anybody who was attending the Instagram lives that we used to do, we talked about these three underlyings very, very often. So as you can see down here, we were really charting very intimately what was happening with Newmont, Freeport McMoran, and McEwen for, back here in 2024. And when we started to see it kind of breaking out and holding and moving up, starting to break out, we did encourage everyone to continue to scaling into shares. And of course, you can see that has had some massive returns if you were taking these trades since we were calling them out. And these markings have been on my chart literally since 2024. Because a lot of people did ask me, like, you didn't talk that much about commodities or oil or energy the last, 6 months. And the reason is because, those were building bases for so long that it just made a lot of sense to start building positions while they were in the base and then just to let those kind of explode. And it's not just commodities. I mean, we were talking about water stocks. We were also talking about like, different commodities like uranium. Even in our lives with different people like Derek, we talked a lot about the potential in gold, in silver, in copper. So, it wasn't that we weren't trading them. It's just that we positioned ourselves early on. So when the breakout did happen, we weren't trying to find ways to participate. We were already participating. Now, this doesn't necessarily help somebody who's only been in the Discord for 2 months or 3 months, because of course, if we've been in these trades since back here, it wouldn't be of good faith for me to tell you in December or October to start scaling into a position. Because for those who have been scaling into the position since 2024, 2020, early 2025, all your risk was to the upside, and you've already had more than 100% return on all three of these. Well, for McEwen, you might already have like 300% return on the trade. So, I do want people to understand that it's not that in the Discord we only talk about options. It's just that for a lot of people inside the Discord, their main concentration is on trying to generate that extra income so that either they can use that for their day-to-day lifestyle or so that they can start scaling into longer duration plays that are a little bit more cost intensive, but without tying up their entire portfolio. All right, friends, if you are interested in knowing more about, what we are doing at Trade Speakeasy, then I would encourage you to check us out in the Discord and to check out our school courses. All right, bye for now, friends.